In this model, we cover some of the basics about what kind of changes the private equity ownership may have on the company's operations, and both in terms of the governance of the company and the managerial operations. And the importance of understanding this for the advisor to the company is that they may well play an ongoing role, a typical role that could be played by a trusted advisor of a company, that they could join the board of directors. It's typical that the board of directors may be increased or strengthened by agreement by our post-investment. And a very good role for the advisor would be to participate on the board, representing the interests of the ownership of the company, the original ownership of the company, and help bridge the gap between the expectations and the requirements of the PE fund and their methodology of management, and what the previous owner is used to in terms of the company management. And this is somewhere where the sell-side advisor could play an important role, and in order to prepare for this role, a sell-side advisor, apart from going through this module, would be able to participate in some courses, particularly on corporate governance and how to enhance the corporate governance and strengthen the management of companies post-investment in private equity. The main objectives of this module are really threefold, and all three of these points are important for any advisor to the company. The first part of the module, we consider how the private equity value addition model works. In other words, once the private equity investor has made their investment, what are their actions and behaviors? What is their approach to achieving their objective, which is to increase the value of the company over one economic cycle, or therefore over a period of years, and understanding their motivation and their general types of approach is essential for any sell-side advisor or advisor to the company. Secondly, the private equity fund is looking to upgrade the corporate governance of the company, and so understanding the level of corporate governance of the company before the investment takes place and seeing where the main deficiencies are and the main action points that can be taken is going to be an important role for any advisor to the company. And then thirdly, the different types of interventions made by the PE fund manager, particularly things like reporting and monitoring and value enhancement initiatives, are also something where indeed the advisor to the company could play an active role, because it's quite common for PE investors to create kind of task teams or project teams, which would consist of a mixture of people from their side and people from the entrepreneurial, the former ownership side, to work together to achieve a common objective, such as implementing a new reporting system, such as conducting an acquisition. And it's absolutely right and proper that the advisor to the company could be a member of such task forces. The private equity value addition model. Let's examine some of the critical features of private equity ownership, and these apply both in the case of having an important minority stake and also a majority stake. The first feature is ownership concentration. Typically, a private equity fund will have a large block of shares, and that will give them a strong influence over the company, and this influence may be enhanced by veto rights and other minority protection rights which they would design. Secondly, ownership rationality. The private equity owner is rational, is looking for what's best for the company and to have a strategy. Ownership closeness. The job of the private equity owner is to get involved in the company, and private equity investors will adopt an activist approach in their different ways. Fourthly, building value. The fund manager has a limited time period in which he can build value of the company. He gets his profit if he makes the company more valuable, and therefore the main agenda is to increase the value of the company, no other agenda. Management incentives. The fund manager is motivated to try and make the management share their view, and they can do that by providing economic incentives to senior management, as well as encouraging the development of a middle management strata, which will make the company more easy to exit down the road. Finally, action and decisiveness. The PE manager is on a time-critical mission and therefore is oriented to take action in the face of problems or weaknesses rather than to procrastinate. Comparison with other company models. If we compare the model we just described, showing the critical features of PE ownership, and compare that to other possible models of companies. Let's start with a family company. In the case of a family company, we do have ownership concentration. The rationality of the ownership will depend on the family. In some cases, non-rational factors may come in, such as a succession to a weak child, for example. Ownership closeness, yes, in a family company. Building value, not necessarily. The prime objective may be lifestyle or leaving it to the next generation rather than building value over an economic cycle. Management incentives, family companies tend to look for loyalty in their management class rather than provide them with stock option type incentives. Action and decisiveness, not so much in family companies where decisions are often made according to the family's convenience. So a family company will only qualify 2.5 out of the 6 criteria. Let's take the second example of a quoted widely held company. Ownership concentration, no, it's widely held. Rationality of ownership tends to be yes, because it's institutional investors. Ownership closeness, no, the ownership is remote. Building value, that will depend, but frequently not the case. Management incentives, that will depend. Often the issue is that senior management will get large bonuses but not performance related. Action and decisiveness, no, because of internal bureaucracy. So a word widely held and quoted company will score 2 out of 6. State-owned companies, similarly, ownership concentration, yes. Rationality, not always. It's more political agendas. Close to ownership, no. Building value, no. Management incentives, no. State-owned managers tend to be on fixed salaries because of politics. And decisiveness, no. So these are all structural factors which will have the effect of weakening the company's performance. We have seen some reasons why private equity-backed companies are stronger performers, which are structural. Let's look a little bit more at what the actual fund manager may do. This is a study that was done by McKinsey, in which they analyzed a series of investments, and they then stripped out the effect of a market uptick and of financial engineering leverage, and looked at company outperformance. They then divided that into 3 different categories: the top third, middle third, and bottom third. The study found the following results. They tracked the correlation between the performance of the investment and the amount of time spent by the fund manager. And if you look at the table, you can notice that the top third of investments, the fund manager spent half of his or her time with the company during the first 100 days. And we also notice that they had regular interaction with every single company. If we compare that to the bottom third of the investments, we see that the fund manager only spent 1/5 of his time with the company during the first 100 days, and they lost contact substantially with half of their companies. They only interacted regularly with the top management in 55% of all cases. So there was a strong correlation between the amount of interaction and the intensity of involvement in the first 100 days. We can break down the different models of contribution of the private equity fund manager to an investment into 6 categories. Entry, which means buying the company at an attractive price, requires investment banking skills. Financial engineering, meaning better financial management of the company or introducing leverage into the company, requires investment and commercial banking skills. Earnings growth, so growing the earnings of the company either through acquisition or through organic growth, requires operational type skills. Margin expansion, improving the profits of the company either through managing costs or repositioning, also requires operational skills. Corporate governance, upgrading the corporate governance of the company, requires consulting and accounting type skills. An exit, therefore, having an exit perspective on the whole investment is a unique private equity skill, which is we could describe as the exit-driven perspective, which should drive all the decisions the PE fund manager makes. Okay, that we've discussed so far a little bit of theory and some perspectives on how private equity fund managers approach their investments and where they're coming from. So let's dedicate a brief section to looking at it from the point of view of the manager or the owner of the company, what it tangibly means to the owner of the company when the private equity fund is getting on board into the capital of the company. As we've previously discussed, the PE fund is what we would describe as an active investor, which would correspond to the terminology of hands-on. However, there will be differences between the different types of PE funds. Some will have a more hands-off approach and leave things more to management. Others will have a more hands-on approach. But one thing that will vary is the level of hands-on and hands-off according to the situation of the company. Now, what's clear is that private equity firms do expect the management to perform on time within plan and to hit the targeted numbers. This is something they look at very intensely, but also because whenever a private equity fund makes an investment, the senior person in the fund who is acting as the champion of investing in the company within his firm and towards his own investors has put his own internal reputation on the line, and therefore this person will be keenly aware of what is going on in the company and very sensitive to any problems that may emerge. And so, depending on the performance of the company, we could describe hands-on or off from the point of view of the fund manager as a swinging needle or a pendulum. And clearly, if the company does not perform and there is a problem, the management should expect that the PE fund managers will get much more hands-on than they would otherwise. And this will get even more the case because post-investment, the pace of the company's operations will increase, which means there is a higher risk of problems and difficulties, particularly in the early stages. In practice, we've seen that private equity funds invest in companies because they wish to accelerate their growth. And what does that mean? That means there's going to be a high level of action right away. As soon as the investment is made, there's going to be changes, and the private equity fund is going to expect to make these changes. The company is destined to become bigger, which means the pace of the operations are going to get quicker. And one of the questions that will come up is the current management team able to perform? Because what we are asking them to do is to start to cope with a growing company with growing complexity and a faster pace and a more strict holding of people to their targets. And so what you can expect to happen in any management team is there will be changes and a natural evolution. Some people will require additional training and then may perform and thrive. Indeed, that may be the opportunity they were looking for to take their career to the next level, and they welcome the private equity investment. Other people simply need to go because maybe they're just working in a different way, that they just want a 9-to-5 job and a salary, and everything that's changing here for them is just stress. They need to go. And when do you make these changes? Well, the PE fund manager expects these changes to be made right away. They do not like to see problem people in key positions holding things back while people think about what to do. And in this regard, private equity investors, obviously because they are a bit new into the company, are much less sentimental than the company owners who may have long-standing ties with employees, or who employees are going to be connected to them through the local business community. And this is something that has to be addressed and will need to be addressed. One of the things that's going to happen in the company post-investment is the rate of change will increase. The company will be changing. Things staying the same and just growing a little bit faster is not an option, and therefore the management and the company owners need to adapt to the change, and the way to adapt to change is communication. Change means problems will emerge, and the secret here is that there is a saying that good news travels fast and bad news travels through the slow train. This is wrong in private equity. If there are problems, it's essential that the management discuss these very early with the private equity investor, because if they hide the problems through some misguided ideas, that will destroy the trust of the PE firm towards the managers, and those managers may have their position may be at risk. Changes can be caused by all kinds of reasons. It can be economic conditions. It can be the fact that once a company is private equity backed, that may trigger a reaction by competitors who see a greater threat and who may take actions. So there will be uncertainty, and the high uncertainty will create more unexpected changes. Private equity fund managers are okay with that. There is no problem calling them with problems which have been triggered. They're expecting it, and therefore the importance is communications. And from the point of view of the management, it's important to adapt to be a more flexible, to take a more flexible approach and be ready to change plans more quickly than in the past. One important thing for management is to understand the focus of private equity funds on EBITDA. Now, obviously, EBITDA is an accounting metric. By thinking about EBITDA isn't going to create value or increase the sales, but it's important to be aware of it because it can inform certain decisions and certain approaches to be taken in the company. Traditionally, a company owner, before the private equity came in, would traditionally focus on reducing his tax bill by having having his profits lower and having a good cash flow. They were not focusing on EBITDA. That was just one of the accounting numbers. However, when EBITDA is the main focus, there will be some tangible changes. One is obviously that you would look at EBITDA as your principal metric of performance, and this means things like, for example, trading operating expenses for CapEx within reason, because if you make a capital investment which you depreciate, that is better than having it as an operating expense. Thinking as for EBITDA than for cash, and then one-time items, for example, such as consultants, rather than hiring new employees, they will get added back to EBITDA because the one-time special items, when we compute an adjusted EBITDA to really value and understand what the company is doing, these items will get added back. Let's now look at the three growth strategies that PE-backed companies would employ and their effects in terms of the tangible effects on the management and the day-to-day running of the company. On the third growth strategy of buy and build, we've discussed at some length in another module, so we will examine it really from the perspective of what it means to the company's management. Organic growth really corresponds to what the company has been doing all along before the private equity investor came on board. And so when we consider organic growth post private equity investment, what we're looking at is doing the same thing but accelerated and better. So not something new, but what we're doing already before. And how can we grow organically? Well, to grow sales organically, there's two variables, the price and the volume. And so firstly, price. What we would do here is the PE fund would expect management to take a long, fresh look at their pricing policy. Is it possible to increase prices? Have we analyzed our customer base better? Have we segmented it properly? Have we looked at what the customers are really looking for? Could we do more with our customer base? Typically, many company owners in the emerging markets are more production focused than they are customer focused. So improving customer knowledge is one thing. And secondly, the price elasticity. This has been the price for many years. Is it possible to increase prices? So PE funds were going to expect more work to be done on this area. In terms of volume, how do we grow volume? Well, the PE fund is going to expect the company management to look again at doing all the things, such as, can we improve our sales and marketing effort? Have we got too many salespeople who are simply servicing existing customers? Do we need some people who are, let's call them hunters, who go and look for new customers? Typically that's a problem, that salespeople are servicing customers and taking orders and expecting the owners to find the customers. That needs to change. Tiering products and services, so maybe repositioning the products into different price tiers, rebranding the products, revamping the marketing operation, and then finally, most importantly, finding what's called blue ocean. This means, should we just think laterally and try and find completely new customers which we haven't serviced before, simply because we haven't thought about it. Margin expansion means working on costs and being more efficient. One obvious area is post private equity investment is if the owner or some of the shareholders have personal expenses in the company, that's going to have to change. They're going to have to come out, or some arrangement's going to have to be made. So that's a simple change that will result in private equity investment. And secondly is the PE fund will be expecting the management to take a long, hard look at all the costs and see if things can be done to improve the margins. And the two approaches, one is, can we use technology to drive productivity? Can we implement CRMs and other types of automation? So investing in technology is one, and secondly is to challenge the status quo, the way things are done, the processes. So the P funds are going to expect the management to take a new look at the processes, production, distribution, and sales processes to see if things can be done more efficiently. And this is also where specialist consultants might be coming into play. We discussed buy and build strategy in more length in a previous module, but let's consider from the point of view of the management of the company. Now, firstly, organic growth and margin expansion will take time. It does take a while to organize internal operations. Private equity funds are not patient, which explains the strong popularity of acquisition strategies in private equity-backed companies. Why do you make an acquisition? Well, it's to fill a strategic need, like a missing product line or something such as that, a technology that's not available. It's secondly to build density in an existing geography, to buy a competitor and increase your market share and have more customers in your existing region. And thirdly, to diversify, to expand the geography. And all these will have slightly different implications, but the acquisition will be the same process. The advantage of buy and build is it does grow the company very quickly. The disadvantage is that it creates a lot of change and uncertainty among the employees and indeed among the management. And the way to deal with the success, to make it successful rather, is to have an integration system in place, an integration playbook in place, and this is something where the private equity fund can help very much. And the two key components of an integration playbook is one, that the ability to put together a project or a task force charged with integrating the acquisition, and there's no reason why the private equity fund cannot be a part of it. There's no reason why we could not have a consultant to the company being part of the project team, such as the consultant helping the company owner at the time of the negotiations. And then we break it into methodologies by using Gantt charts and process techniques. And private equity firms are definitely here to provide the skill set to assist with that. It's not something the company would ever be expected to do on their own. One of the questions that the company owners or the managements are going to have to accept, and there's really no alternative, is the role of consultants in private equity. Now, traditionally, company owners tend to be anti-consultant. It's I know my business best, nobody else knows my business like me and could tell me how to run it. Consultants are expensive and don't really provide any value. These are the typical reactions you might hear from company owners. However, private equity investors do not share the same view, and the owners are going to have to accept that. Consultants, what can consultants offer? They can offer best practices from other experiences, having worked with other companies in other countries or in other sectors. That's something they have. They can offer a different view on things, a fresh view, and they can help with search. In other words, if the company needs to integrate an acquisition or do a big organic growth drive, it takes time to train people. It takes time to hire people. The company may be capacity constrained. Consultants can help with that, with a surge, in order to get to very quickly to another place. And so the opinion of private equity fund managers is that they do not really believe that consultants are there to substitute the expertise of the owner or of the entrepreneur, of the CEO, but they are convinced that consultants are experts in certain areas of business processes. They may be experts in the sales process, in kind of production process efficiencies, and that is where they need to be deployed. So private equity firms will be wanting to deploy consultants, and any owner who resists this based on a kind of a mindset from previous times is going to be inviting difficulties. So having discussed briefly what private equity investment means for the company and the management after the investment has been made, and it is clearly disruptive, but it can be disruptive in a good way, provided the management and the company embrace what the private equity firm has to offer in terms of knowledge. Now let's look at how the actual P firm will themselves organize themselves towards the company in order to understand where they're coming from more effectively. In terms of the type of intervention by the fund manager, we can distinguish three broad categories. One is corporate governance, which means the fund manager makes sure that the company's corporate governance is upgraded. This means by introducing audited accounts, introducing management reporting systems, making sure the company complies with all the legal requirements. Secondly, a network. The fund manager puts his network to the disposal of the company so that they can have a better access to customers, suppliers, financial partners, and others. And thirdly, management. The private equity fund manager will play a role in the management at the board level in terms of getting involved in recruitment decisions, and sometimes even in a semi-operational role. We can distinguish three involvement models of a fund manager: basic involvement, a medium involvement, and a high involvement. And this is related to having that the fund manager should have a template for the type of intervention that they would implement, and this template would be in place ahead of the investment into the company. We give here an example of a basic involvement. A basic involvement by a fund manager could mean that they attend the board meetings, they respond to a reasonable level to email requests from the company, and they have a quarterly meeting with the company to discuss strategy. And the services provided would be that the fund manager would mobilize its network and help the business to develop. And this could be considered a basic involvement, which would be, let's say, the minimum that any company should expect from a PE fund manager who's an investor in the company. A medium involvement model would be a step up as required by the company. An example of this could be, apart from board meetings, now to have a monthly strategy meeting with the company and attend occasional meetings with a potential customer, investor, partner, or employee. And in terms of providing services, get more involved in hiring team members through the network of business contacts of the fund manager. And finally, the high involvement model would be when there's a clear need to enhance the involvement of the fund manager. An example of this might be to have a strategy and management sessions with the company twice a month and an occasional corporate retreat, and provide part-time support to the company from a junior team member being seconded, for instance. And this would be stepping up the acquisition of customers and partners and assisting the company on strategic projects by seconding somebody. Question 1. What best describes the private equity fund's high involvement in the invested company? Please select all relevant ones. A. Have strategy and management sessions with the company twice monthly for 4 hours. B. Assist the company on strategic projects, acquisitions, major financings. C. Attend occasional meetings with a potential customer, investor, strategic partner, vendor, or employee as they arise. D. Attend meetings of the company board of directors. In this reading, we discuss the case of GlobalNet. GlobalNet was a Croatian internet service provider, and a private equity fund made an investment into GlobalNet in the early 2000s and helped the company develop. And this is a very good example of a venture type investment where the three original owners changed their role in the company following the investment by the private equity fund. And it's also a good analysis of exactly what kind of role the private equity fund manager played in the management and the governance of the company. In this reading, we review the case of Digital City Media, another Croatian company in the sector of cable television, in which Soros Fund made a 11 million euro investment, so it's a fairly large investment. And we discover how the company evolved. This company is already more developed. Some of the original entrepreneurs have left the company, and there was another smaller fund that already invested. And it's a good example of how companies on a slightly larger scale will change and grow as a result of another layer of private equity investment. It also describes some of the challenges companies may have to grow from being a relatively small company to a larger middle-sized company. In this case, we consider the case of Mactel, which is the national telecoms company of Macedonia, in which Deutsche Telekom invested about 20 years ago, along with a co-investor, which was private equity fund, Southeast Europe Equity Fund. And this was a $350 million transaction. And it's a good example of specifically the governance changes which come from a private equity investment. Enhancing corporate governance is one of the most fundamental tasks that a PE fund will be looking to achieve during the period of investment into a company. And the different parts of corporate governance will include things like improving the financial reporting systems, such as having audited accounts and financial reporting systems. But the other very important part of it is the general managerial governance of the company, which is expressed through the board of directors of the company. And this is something that the PE fund will pay a lot of attention to, because parallel to any company's growth has to be necessarily an upgrade in its corporate governance structures. And this is something that PE funds will pay a lot of attention to, and a very important role for any advisor to a company is to be part of this process and participate in this to the fullest extent possible, because it can be that many company owners may be less familiar with the transition and may require some support. So this is an important role post-investment for any advisor of a company or its ownership. The definition of corporate governance is a set of rules governing the way the directors interact both with each other in the effective management of the company and with the shareholders in their accounting for their stewardship of the company. More broadly, we could consider corporate governance is the series of actions that make for the companies to be better managed. Some of the key features of sound corporate governance are the following: independence of the board from the CEO's vision. This means in practice separation of the chairman and CEO functions, independence of the supervisory directors, a high proportion of non-executive directors, and the CEO does not play a role in the nomination process of any board member. Secondly, board and shareholding structures. Medium or small size boards. Large boards are considered less effective than small boards. Tends to be an increase in agency problems when the boards become too big. Presence of large shareholders. Firms tend to listen to the market more when some of their shares are held by large and active shareholders. Compensation schemes linked to shareholder returns. Remuneration is one of the most sensitive corporate governance issues in the current economic environment, attracting public, investor and political attention. Share ownership is said to align directors' interests with that of shareholders. Corporate governance matrix. The attached corporate governance matrix can be a useful tool to assess the level of corporate governance of a company as part of the strategic analysis process or the due diligence of this company. In this reading here, we consider a corporate governance matrix, which is a framework which we have prepared based upon UK corporate governance standards, which allows any advisor to categorize a company into 4 potential levels of general corporate governance of the company. And obviously, if a company falls into a lower level, then the task is to increase the level of that. And then that means that for any advisor to a company or their ownership, using this matrix to do a diagnostic of the level of corporate governance of a company before the private equity investment is taking place can be very important, because it enables the generation of an action plan which can prioritize what are the main areas to improve or change in order to upgrade the corporate governance. And this exercise can be a very important component of the sell-side due diligence to be performed. Board of Directors. The Board of Directors is a group of individuals that are elected as or elected to act as representatives of the stakeholders to establish corporate management related policies and to make decisions on major company issues. Function of a Board of Directors. Recruit, supervise, retain, evaluate and compensate the managers. Provide direction for the organization. The board has a strategic function in providing the vision, mission, and goals of the organization. Establish a policy-based governance system. The board develops policies to guide its own actions and the actions of the managers. Govern the organization and the relationship with the CEO. Fiduciary duty to protect the organization's assets and members' investment. The board has a fiduciary responsibility to represent and protect the members' investors' interest in the company. Monitor and control function. The board of directors has a monitoring and control function. The board is in charge of the auditing process and hires the auditors and makes sure the audit is done in a timely manner each year. Characteristics of effective boards. Cultivate a healthy relationship with the chairman. Select an effective board chair. Establish an effective governance committee. Delegate appropriate decision-making authority to committees. Provide appropriate oversight of academic quality. Consider strategic risk factors. A good company vision. Focus on accountability. Create a culture of inclusion. Uphold basic fiduciary principles. A research by Harvard Business Review identified certain factors which led to boards being either effective or not effective. Length of meetings. Effective boards would have a meeting of about half a day. Less effective boards, a short meeting or a whole day meeting. Items on the agenda. An effective board would have 5 to 8 major substantive items on the agenda. Less effective boards, more. The amount of time spent by the chairman talking in effective boards would be 5 to 10%. In less effective boards, 20 to 30%. Presentations by senior management in effective boards would be no more than 15%. In ineffective boards would be up to 70%. The total amount of time spent as chairman per year in effective boards, 25 days. In less effective boards, 40 days. Balance of a board of directors. These are some of the key success factors to make for a balanced board of directors. Boards must be a working group of members who trust and understand one another. So group cohesion and trust is essential. The group must be the right size with the right balance of non-executive and executive directors. Ideally, the non-executive directors should be more than the executive directors. Have a good mixture of abilities, knowledge, and experience, so complementary experiences, skills, and knowledge. The ideal size of a board depends on a number of factors, including the age, the ownership, the structure, and the financial profile of a company. But being the wrong size may limit the board's effectiveness, such poor decision-making, or may limit the knowledge and experience around the table. The average size of effective boards in the UK has been suggested by the Institute of Directors as being between 6 and 10 directors, depending on the size and the complexity of the company. What is a non-executive director? A non-executive director, also known as NED, is a member of the company's board of directors who is not part of the executive team, therefore does not work in the company full-time. A non-executive director typically does not engage in the day-to-day management, but is involved in policy making, planning exercises, and supervision roles. Here in the next few slides we give a few profiles of typical board members you might find in a somewhat also humorous way. The positive board members, the first one, Miss Perfect, would be the ideal of a good board member, having strongly held views, being a good listener, being motivated by the best interest of the company, not willing to go with the flow or the majority decision if he or she feels it's wrong, not politically correct, and oriented to take action in the right way. A heavyweight might be a celebrity member of the board or a major shareholder or a renowned expert, and they would carry this extra weight of credibility from their previous profile. The grizzled veteran would be a board member who is of more advanced years, who's seen many things, has an instinct of what to do because of the vast experience, and doesn't have any political agenda of his own. Here we have some board members who may be problematic, and here are some typical profiles that may be found. The cafe operator, who is somebody who has good ideas, but for some reason will not bring them up in the board meeting and only wants to discuss them in around the board meetings or in breakaway groups. Mr. Angry is somebody who is likes to make issues about nothing in the board discussion and has something to prove. The political animal is somebody who wants to take credit for all the good decisions and stays silent in the board until the end. The slick talker is somebody who has a good talk, uses a lot of good jargon, but there's never any action taken and no depth in his knowledge. The debater is somebody who likes to have debates about every minor point just to waste everybody's time. Miss Positive is somebody who is frightened of confrontation and feels everything should be positive, which often does not lead to good outcomes. And Jargon Jim is an individual who likes to use incomprehensible technical terms and slogans which nobody else can understand. Some other board profiles you might find in emerging markets would be the political appointee, somebody who's appointed to a board where the state has a significant ownership, and they tend to have no real interest in the details because for them it's more reward for political service. Another type is the oligarch appointee, which is an individual appointed by an oligarch type owner, and the problem with this board member is that they have no authority whatsoever. They're just there to listen and to report back, and so it's very difficult to engage with them in any discussion. And finally, the frightened rabbit is somebody who's appointed by somebody but not with a full authority, and who feels that their survival as a board member depends on being popular with everybody, and that's what their main focus. Question 2. What characterizes an effective board of directors? A. Focus on accountability. B. Identify good company vision. C. Establish an effective corporate governance. D. Come to meetings in order to tick the box. E. Select an effective board chair. Roles and responsibilities of non-executive directors can be broadly put into 4 different categories. Strategy. Non-executive directors should constructively challenge and to help develop proposals on strategy. Performance. NEDs should scrutinize the performance of management in meeting the agreed goals and objectives and monitor the reporting of performance. Risk. Non-executive directors should satisfy themselves on the integrity of financial information and that financial controls and systems of risk management are robust and defensible. People. Non-executive directors are responsible for determining appropriate levels of remuneration of executive directors and have a prime role in appointing and, where necessary, removing executive directors and in succession planning. Some of the value added of NEDs is major investment decisions against economic instability such as fiscal uncertainty or exchange rate fluctuations, understanding the opportunities and challenges of emerging technologies in terms of improved customer service, better margin management, more efficient operations, and significant competitive advantage. Evaluating the risks and potential benefits of outsourcing corporate services, selecting the most suitable partners, and negotiating the best contracts. Establishing remuneration policies and appraisal schemes to reflect the particular characteristics of the business, linking executives' incentives with both long and short-term corporate objectives. Assessing the strategic options available to a company going through change, such as access to investment capital or new product development, the evaluation of new markets at home or abroad, opportunities for mergers and joint ventures, above all, taking a dispassionate or lateral view of the business to find innovative ways in which the company can reposition or even reinvent itself. Sometimes it can be complicated for a non-executive director appointed by the private equity ownership to engage, for example, in a situation where the other shareholder is the entrepreneur founder who may even have a majority stake. This was a study done by a major investor, and we quote some of the 5 opinions certain founders had. 1. Individuals seeking a personal gain. 2. Less talented, fortunate, or hardworking individuals than me. 3. A burden I need to live with for legitimacy reasons. 4. Strangers invading my house and advising how to rearrange it. 5. Childless experts in child rearing. So we can see that often the shareholder founders may have certain hostility or skepticism towards the private equity appointed non-executive director, and that means there is a challenge in order to get established and accepted and develop a working relationship. Sometimes the expectation of a non-executive director's contribution may be quite high and often not articulated by the other side. These are some examples: to bring in new business, bring better financing, introduce me to business circles, act as a protection from the government, tell me how to sell more. This was a sample of European entrepreneurs, Central European entrepreneurs, who had brought in an NED from a private equity type investment. For any non-executive director appointed by a PE fund, the steps to develop trust would be initially to get the attention of the other side, to get their interest with good ideas or proposals or actions. This will lead to respect, which will lead to working trust in a relationship, which can then be ongoing and stable. Here are two studies specifically about private equity appointed directors. The European Venture Capital Association study showed that private equity backed directors spent 3 times more time with their companies than the others. And the McKinsey study looked at the alignment of the director skill with the type of expansion. And as you might imagine, the expansion based on organic growth, the directors had a more operational background, and for an expansion based on acquisition, the directors had a more financial background, which is obviously as one would expect it. In this exercise, we map out the potential approach that could be taken by a PE investor to manage one of their investments. And therefore, if the sell-side advisor or the advisor of the company is familiar with the approach taken by the PE fund, they can be part of this process and bridge the gap. And so this exercise presents a situation of a company post-investment after a few years, and lists different decisions that need to be made and agreed between the PE investor and the original entrepreneur of the company. Post-investment monitoring and value enhancement. Management approach. From a financial point of view, it's likely that the private equity investment will result in the accounts being audited. It's also possible that a new CFO may be selected as part of the private equity transaction. And this also may mean that there will be a dual reporting line from the CFO to the CEO directly to the private equity representative. And finally, strong rights of inspection to the company will be given to the private equity representatives as well. It's likely that the PE investor will implement a value enhancement program into the company, and this will have the effect of improving IRR, increasing revenue, increasing EBITDA, providing cash for management buyouts if this is the exit route, try to compress the time to exit, and obtain higher exit multiples. The main types of reporting structures that may be implemented by the PE manager would be a monthly reporting system, flash reports, action plans for specific items, a working capital plan related to inventory and accounts receivable. Monthly reporting would have the objective of providing concise and accurate overviews of the company's performance on a monthly basis, and will focus on certain metrics such as sales, EBITDA, cash flow, and other relevant metrics of the company. The report must include a comparison to budget and an analysis of variances from the budget. And this should be used as a basis for discussion with the management as to what is working, what isn't working, and what measures can be taken to improve operations. In this slide, we give a typical example of a monthly report for a generic company. And you can see here we've got a budget, a year-to-date column, a monthly column, and an analysis of variances. A flash report would be typically prepared on a weekly basis and is often used when there's some period of concern for the company. And it would provide a brief one-page overview for the management and the staff of the private equity fund. It would focus on only a few key performance areas of the company, and would be used as a basis for a weekly discussion between the management and the private equity fund staff. Here on this slide we can see an example of a flash report, and so you can see we have planned and actual, and the key high-level items are shown here as revenues, gross margin, operating expenses, and an operating profit. And so it's a few limited items which are reported on a very frequent basis in order to anticipate any problems. Action plans are short one-page plans of certain actions that need to be taken who is responsible for this, and what is the timeline. And these can be reviewed by the management or the fund managers to check progress against the agreed actions. Here we show an example of an action plan, and this is to do with improving the level of customer service. And we see there's 4 actions required. There's different people identified and a date by which it should be done, and the resources or time, man hours required to do that, and the results expected. Another area where improvements can be made, often in a short period of time, is working capital, and this can be used to identify areas of savings, enhance revenues, and enhance the gross margins. In this slide we give an example of a working capital report. We see we have different categories of product and see what percentage of sales they represent vis-a-vis the percentage of inventory, and this allows for savings to be made. So in this example, the savings will be made by establishing new goals for the supply days, listing the history of sales prior to the new purchases, knowing exactly the amount in inventory at the present time, having a special approval to go over the limits, and sell slow-moving units at a discount to generate cash and lower the number of items held in inventory. Other value-enhancing actions or opportunities are involvement in strategic planning by the fund manager, improving the level of market research, getting involved in hiring new staff, designing and assisting with the execution of an incentive compensation plan like a stock option plan, helping to raise additional capital, and exiting. So these are all actions that the fund manager will get involved in at some point during the company's life. Question 3. What are the types of post-investment reports? A. Monthly reporting. B. Daily reports. C. Flash reports. D. Action plans. E. Working capital. So finally, I would like to express my thanks to the World Bank for allowing me to share a version of the course that I developed with them and put it online on my website, on my LinkedIn profile. So thanks for that. Secondly, all the modules, this module and all further modules, will have a certain amount of case studies and additional materials attached to the module, which are part of the learning experience. These materials I will be posting on a specially created group that I have made in LinkedIn called Gavin Ryan PE Course. All you have to do is search Gavin Ryan PE Group, and the group will come up for you to join. You who are following this course, you'll be eligible to join my group and get these additional materials once you've connected to me on LinkedIn and once you've subscribed to my YouTube channel. So when I receive a request to join this group, I will check these 2 things and then I will admit you to the group. So thank you very much for your attention. I hope you've enjoyed this module, and I look forward to seeing you on the next module.